Okay, and I think we'll just go ahead and get started, everybody. Welcome to the 14th Annual Social Responsibility Forum that's hosted by Net Impact. My name is Amelia Nielsen, and I am a coordinator with Net Impact. And you are attending our panel on impact investing, particularly reimagining impact investing for a world that is just and sustainable. That is the overarching theme for Social Responsibility Forum this year. We are exploring the ways that we can reimagine capitalism to be a net positive for people and planet. This panel is also co-hosted by the Asset Management Club at IE, and I know that Jonathan Lumbin is our representative from that club. And I would like to now hand the baton over to Grace Obado, our moderator for this panel, to introduce our wonderful speakers.
Thank you very much, Amelia. And thanks to the Net Impact Club and Asset Management Club for organizing this panel. So without further ado, I will introduce our panel. The introductions, they have such long CVs. The introductions will be brief so that we can have more time for discussion. So we are very lucky to have with us today Mr. Asier Anseroma, who is originally from Spain and holds a degree in economics and political science from the University of Michigan. But after graduating, he worked at IESE.
You can just call it ISEC.
It's called ISEC. I was wondering, okay, so he worked at ISEC on youth empowerment and entrepreneurship projects in Jordan and several Latin American countries. In 2009, he arrived in Brazil to lead the microcredit team of Instituto Banco Palmas, the first community bank in Brazil. In 2013, he began to shift his focus in Brazil to develop Palmas Lab, a research and innovation space that empowers the urban periphery through the development of youth-based and community IT and research initiatives. Okay, so his CV goes on and on. So just to summarize that in 2016, Palmas Lab was awarded by the Ford and Ashoka Foundation in the Challenge Human Rights in Latin America. So accolades that he got from those projects. And from 2016 to 2018, he was a Melking Community Fellow in Transnational Community Democracy at MIT Collab. In 2019, he joined Ashoka as Senior Change Leader to build a global program to mobilize and engage diverse diaspora networks. So it's such a pleasure to have him with us, and yeah, already looking forward to hearing his thoughts. And we are also very lucky to have with us Pablo Santa-Efemia, who is the co-founder and CEO of Bridge for Billions. Pablo is a Madrileño who at the age of 16 got his first scholarship to study at United World College, together with students from over 100 different countries. He graduated magna cum laude as a mechanical engineer from Brown University, and he also holds 2 master's degrees in mechanical engineering and in technological innovation management from Carnegie Mellon University in the US. He is also worked in several countries, including India, Thailand, China, and Austria. And he founded, it's important to note that he founded Bridge for Billions just at the age of 24. And through this company where he helps startups and generally his mission there is to democratize access to entrepreneurship training and mentoring in order to make ecosystems more meritocratic, efficient, and inclusive. And he, in those years, I mean, he's helped over 1,600 companies in 72 countries. His accolades include being named or being listed in Forbes Under 30. He is a Ashoka Fellow, and he also made Choiseul 100 Economic Leaders for Tomorrow's List. Thank you very much. And so we will start by asking you the first questions. If you could, Jonathan, if you could get the slide on. Okay, thank you very much. So I will start by asking Asier, what are the common challenges impact investment has faced in developing countries?
Thank you for the question, Grace, and thank you for the invitation, and hello to everyone who is watching us. First of all, I apologize if I knew you were going to read the bio. I would have tried to make it more readable for you, or to follow a pattern so people actually understand what I've been working on. So I apologize for that, and thank you again for the invitation. To go to your question, I would just say that, you know, I'm by no means an impact investment expert. I'm somebody who has dealt with the industry or with fund managers or development finance institutions. And so I'm speaking more from the perspective I have as a sort of like a social entrepreneur, because before I joined Ashoka, for the past 10 years, I was working in making community banks in Brazil more effective. It's a really sort of interesting model of social finance, where communities can create their own banks or financial institutions, their own currencies, and anyway. So I'm going on a different tangent here, but I thought it was important for you to sort of see where I'm coming from when I speak what I'm going to say. So when it comes to the challenges of impact investment in developing countries, I mean, if you look at it from the perspective of the fund managers, intermediaries, or investors, a lot of what you're going to hear is, well, first of all, there's lack of an industry for impact investment, meaning no legal framework or weak legal framework that allows to protect investments, for example, right? That's the thing. Investors want certainty. And when you're dealing with impact, the perceived risks of this are always higher. So legal framework is always a best first excuse not to invest. Let's talk about excuses, right? The second, and when it comes to building an industry, it's not just the legal framework, but they will usually mention things like there's a lack of communities, or lack of community of entrepreneurs and investors, right? So people in the field, if you're talking about Nigeria or Brazil or India, lack of players in the field, whether it is social or impact entrepreneurs and investors, to actually help co-invest or co-create or learn from the perspective of the entrepreneurs. There's a lack of a pipeline. These are the sort of things you hear from the investor and fund manager side. You also hear things around risk or the perceived risk. So it's always, when you come to impact investment in developing countries, the perceived risk that many investors have, because they also don't know things on the ground, is that the risk is higher, therefore the return should be higher. So you get into a lot of this, the conversations that really lead you anywhere, which is really problematic. And that's what I've, a bit of what I've found. And then, the metrics conversation. So how do you measure the impact? There aren't clear metrics on the different fields or the different sectors. And so a lot of these conversations, go on and on and on with little solutions. But to me, part of this problem comes from, perhaps like a definition of what impact investment is, right? Where in many ways we're trying to align money with values. But if you look at reports about how much money was invested in impact investment, and you hear figures around like $500 billion, I think, or something like that in recent reports, very, very early on, they begin to like segment the economy and divide business investment, philanthropy, and the different things. And instead of building an industry, you sort of build like different niches that don't talk to each other. and then cooperate or collaborate. And to me, that's very problematic. So that's what I saw from Brazil, right? Looking to different kinds of investment, whether it was debt, we couldn't do equity, but debt or philanthropy or impact investment, figure out different ways. These were some of the usual conversations. But then from the perspective of an entrepreneur, like what did I see that was missing from the first step would be a lack of understanding of how a social entrepreneur or impact entrepreneur goes, what's their process. Is it individual? Is it collective? Does it involve just him or her? Does it involve the community? How do they come up with the idea? How do they scale up? What is their breaking point, or how do they, trigger how the solution goes from just being something that solve a concrete problem to something becoming more systemic. There's very little understanding. There is some literature, and there are some universities working on this, but from the entrepreneur, when I talk to potential investors, I had no understanding of these processes, and that's very complicated. They also don't understand the beneficiaries of a lot of this innovation. So there's a complete lack of knowledge. So they have a lot of financial education. They learn, of course, the investors and the fund managers know a lot about finance, but they don't know a lot about impact or social innovation and how it comes about and how much of it is a collective process in many ways. So anyways, I would say those are some challenges, and I'm finishing because I want to be concrete and not take too long. I would say not only up until now, I've said a lot of standard views on what are some of the challenges, but from the perspective of an impact or social entrepreneur, one of the problems I found was that they don't commit to their guidelines. So I'm not going to name names, but I remember working on a green microfinance initiative where we're trying to build a portfolio to support local small businesses in the urban periphery of Brazil become more sustainable, to discuss the environmental issues, use renewable energies where it's possible, building a sort of like a local industry to work on this. And I remember, in their guidelines, this Latin American Development Institution, and again, I'm not going to name names, created a guideline for this initiative, and you would send, every year they will come out, they have some funding to support this sort of organizations. But one of their guidelines was the collateral, right? That as an organization, you needed to have to receive this investment. And they say, just, it was part of the, a list of things you needed to tick. And they would ask you this question: do you have a 10 or 15% or 5% of collateral where for this investment that you're requiring for green microfinance? And they would say, don't worry, the answer to this question will have no effect to how your application is viewed or reviewed or analyzed. And so I did that for 3 different years, and a 4th year, because we didn't have that collateral for that, because our money was tied in other areas. And I was invited to a 4th, a conference after the 4th year to discuss these issues. And only in internal conversations and getting some trust from them was I able to get the answer that in fact our applications hadn't been approved because we didn't have that collateral. So even prestigious development financial institutions, they lie. I mean, this is serious. They provide a guideline and then they don't follow it. So this is sort of like some of the challenges we faced when looking for investment. So it's when you say there's a lack of industry legal framework, you also need to have some self-reflection from the part of the investors, and building trust and creating timelines or timeframes that are more conducive to impact. So we need to work together. That's why segmenting so early is so problematic, but we'll talk about the paradigm shifts in the second question, I believe. But I think building opportunities for seed capital are completely lacking, for experimentation, for really development process where investors and entrepreneurs and beneficiaries and communities are working together is non-existent in many of these countries. And the problem is everywhere, not just on one side. So I would say there are more things. I would end there because I know Pablo is going to have great insights on this and specific examples. So I'll leave it there and develop some more of this comments on the next questions.
Thank you very much, Asier, for those valuable insights. Yes, so now I move on to Pablo. And so Pablo, what was your experience like, especially in developing countries, regarding challenges around impact investment?
Okay, well, first of all, thank you for having me here today. The question is very broad, but just before, let me just dissect, because I think first, before we think of impact investment, we need to think of the challenges that there are, that a lot of entrepreneurs are facing in regards to investment in general. So most entrepreneurs still, this is globally, seed rounds, the very, very early stages, there's still huge gaps in funding, but especially it's very acute in developing countries. When it comes to impact investment, it's even worse. So just to give some numbers, I'm an engineer. At the end, I really like numbers. Just to for example, if we think about this is, for example, numbers for the African continent. The report, if you want to know the source, is Partech, the Africa team. But for example, in 2019, there were 50 deals of an amount of around $4.5 million USD for pre-seed investments in Africa. So that's ridiculous. That's probably like what half of San Francisco could get in half a year. So if we think about the dimension and the lack of access to funding in general, it's huge, especially for the early stages. There is a quote from Tommy Davis. He's the president of the African Business Angel Association, and he says that basically African startups, they need to be going through this valley of death for many times for many years. And you need to be in the 100,000s of revenue in order to get seed rounds. So when we think about impact investment, how easy is it for any impact entrepreneur to go from 0 to 100, 200K without any seed round? So then this generates problems, because the entrepreneurs that are getting their first rounds, they get them basically too late. So they go for seed rounds of 5 million or 1 million, between 1 and 5 million. So just my main argument or comment, it's there is a lack of infrastructure to support early stage entrepreneurs. So if there are very few early stage entrepreneurs being funded, then there are less enterprises to then being funded in Series A, Series B, and other rounds. So this is very similar pattern. I just talked about Africa, but I can also talk about different numbers in Latin America, and it's more or less the same. From my own experience in Bridge for Billions, we support early stage entrepreneurs, so pre-seed entrepreneurs, and most of them, the main challenge, it is true that what we help them do is to connect with the training and the mentoring that they need to really be able to speak to investors. But then the real challenge comes when they don't have funding available within their own national or regional ecosystems. There are no strong business angel networks. These business angel networks are really hard to get into. Many times it ends up in very endogamic relationships where only entrepreneurs that are white, with access to finance, with access to money, have access to this type of finance. There's a really good number that 90% of the capital of startups in sub-Saharan Africa went to companies that had white founders. So the reality is that even the challenges that we have globally, they're still very present in our startup ecosystem. And most of the investors are also, 80% of the investors are European. European or American, sorry. So again, we still have the same biases, and I'll stop here because from my experience, early stage investment is my area of expertise. Series B is growth. I don't focus on that so much. But if you look at any JP Morgan report, or you look at any industry report about impact investment, what you see is that the sector is thriving, that the sector is growing. but from the reality of those early stage entrepreneurs, the world, the things they have not changed. And because of COVID, if anything, we are back to a situation of 2016, to numbers of 2016 for 2020, and we expect to get back to 2019 numbers within 3 years. So the picture that I'm painting maybe is not very promising. I think, you know, we still have a lot to do. But yeah, I'll stop here for now.
Well, thank you very much, Pablo, for those really good points and very much grounded in reality, at least in the African context, which I'm quite familiar with. So moving to the next question, which is, what paradigm shift would you recommend to accelerate the proliferation of impact investing in developing countries after looking at all these problems? So Asia, what would you recommend for Latin America or Africa to address these issues?
Well, I think it's first, it's deal with the problems that the industry has beyond the north-south framework of your question, right? So you're talking about how development, finance institutions, other investor players, a lot of them dependent on governments, and let's say the global north and investors in those regions as well, investing in the south. And that's, you know, that's one avenue we can look into, but there is a bigger sort of paradigm shift that needs to happen, right? Which is around the role of impact investment. Again, if we want impact investment to be this community that creates like incremental changes, and today it's at 500 billion, and next year it's at 550, and then 600, and that's never going to deal with the issues that Pablo was talking about before, right? So we need to have a bigger conversation about what is the role of impact investment in the world, and if dividing and segmenting from the beginning to what's business, what's, you know, ESG, or what's philanthropy, like that just becomes really, really problematic. In the past 10 years, we've increased the amount of money available to investments in so many ways, not least because of what the central banks have had to do to save our assets, essentially, in many ways. And we haven't sort of tailored that to see what are the investments that we need to make a difference. Again, impact investment should be about aligning in some ways, although too late, or maybe too late, values with money. And how do you, beyond those questions, how do we ensure that the trillions of dollars today that are available sort of are shifted into directions that not just include socially and environmental objectives that have to be positive, not just neutral, but how do we involve more people into this conversation, which also goes to the issue around diversity that Pablo was mentioning, right? That we can talk a little bit in a sec. So I would say, like, you know, stuff, like, start from some issues around that. How do we deal with that? How do we ensure that, you know, the impact investment doesn't just become a niche, one more that exists within the current cluster F of things and tools we have in the system. I would say, so, you know, we need a bigger plan, and we need to have also a conversation about the public role, for example, in creating some of those incentives and investment opportunities, especially because of what I said before. Central banks are increasing a lot of the money that is available for investment, yet we're not requiring any of the players on the financial system to change their practices and the way they do, and the impact that they have through these investments, right? I would say focusing also on diversity is a big way in which we can increase or create paradigm shifts that help impact investment become a lot more important, and work with other sectors and becoming more important in Latin America, for example. So the problem that Pablo was alluding to before is it's not just about who are the investors, who are the fund managers, and who are the beneficiaries. Like, in all those three areas, the lack of diversity and inclusion is horrible. And for example, I would say, for my part at Ashoka, that I'm tasked with engaging the diaspora world, I know there are a lot of opportunities from diaspora investments that could be available. Just remittances is much bigger than supposedly what is the market size of impact investment. So of course that's family to family, so it's a different issue, but it speaks to the power that we could be having and creating bigger roles for people that should have a much bigger say in how impact investment is done in developing countries. And the diaspora world is very important in this. How are these actors working with development finance institutions, either as investors or as consultants or as people that know the ground and can help build the industry that we were talking about before? I've talked to Grace a little bit about this, but I think that there's really a big opportunity there that we can work in. And when it comes to I think the next question, it goes from what are some of capacity building and things we can do from the ground on to leverage impact investment. So I'll leave it there and perhaps react to what Pablo says.
Yes, I would like to build on something that Pablo said before and leave it with a question to him. So Pablo, you talked about the face of funding in Africa being mainly foreign, right? I don't want to put a color on it. And so I was just wondering, so would one of the main paradigm shifts be changing the face of that, meaning involving more African to occupy the space of local funding and maybe work in collaboration with foreign companies, but to make sure that the local content is there?
So the short answer is yeah, definitely. But I just want to mention one thing. I think when we speak about impact investment, it's like saying investment, but just with a particular focus. So for me, I don't think it does help us to put impact investment in the same bucket when you have microfinance institutions within the impact investment bucket, and they represent close to 80% of the funds, of the money that is going in impact investment. So like what I'm trying to say, it's I think we need to start breaking the concept of impact investment into what it really means. But yes, Grace, definitely one of the things, one of the paradigm shifts that we need to have is a lot of the money that comes from, like, that goes into impact investment, especially in Africa, it's from DFIs. And then most of it, or a lot of it, is used for microfinance, for financial inclusion. And there are lots of microfinance institutions that are local or they are funded by foreigners, but they are managed locally. But then in terms of the startups, most of the funds, they're still owned or managed by foreigners. Even if you look at the most famous VCs in Nigeria, in Ghana, you always see a foreign face, and the startups that they support, they also have a lot of foreign founders. So that can be one of the paradigm shifts. The infrastructure to support African entrepreneurs or Latin American entrepreneurs needs to be more local, and that means changing the way that who funds who and who supports who, so that it's more representative and you have the right or the more appropriate role models. So that will be one paradigm shift. But then the other, I think, biggest paradigm shift is to accept that, again, this is not only in developing countries, but this is a global thing, that there is not enough support for early stage funding. The biggest, of course, the biggest amounts of money go for later stage, and it's great. But if we really want to develop our ecosystems, we do need to focus on the early stages. Those are the highest risks. And especially in developing countries, it's where it's really non-existent. So that will be the other paradigm shift. Like, let's try to break things into buckets. So when we talked about impact investment, let's not talk about the energy project that is 50 million in south of Ghana, and actually talk about what can you do with 50 million, how many startups can you support in Ghana, for example. No, so I do think we do need to stop putting impact investment in the same bucket, because it does, at least for early stage, it does harm, because we don't see the money coming down. The numbers are increasing, but we don't see the effect in early stage.
Right. So just to add to that, if you know, if we don't deal with the lack of pre-seed investments, there's no way we can turn the ecosystem into being more local and diverse. There's just no way for these other groups to rise and have an opportunity without it.
And just also, when we think of the context of developing countries, it's very diverse. The funding that you have in Nigeria or in Kenya is not comparable to the funding in DRC, Algeria, Cameroon. So there are big disparities within countries. This is in Africa, but the same thing happens in Latin America, where most of the funding ends up going to Mexico, Brazil, Ecuador, but then you go to other places and you have very little funding. So it's a reality. There is a lot of discrepancies within each country. So putting everything in the same bucket is very dangerous.
No, absolutely. I couldn't agree more with that. One of the problems in East Africa with FDIs is that people tend to confuse them with aid. And so the idea of equity just doesn't come in because aid has been around for a very long time. And there's this confusion that with impact investment as being just another sophisticated form of aid. And one of the ways of getting rid of that myth, as you have said clearly, is by bringing local investors into the equation. So we shall move on to the next question. Yes, which is, the overwhelming majority of investment from DFIs. So the largest source of impact of capital is foreign investment. I can't read certain things. I think some of it is covered, so I can't see that.
Yeah,
So,
sorry about that. It just basically says, as the overwhelming majority of investments come from DFIs, the largest source of impact capital is from foreign governments. Within DFIs, the majority of the direct capital is deployed from global and regional actors. So the question here is, what sort of capacity building or internal changes would you recommend to promote impact investing from within as opposed to from outside? So.
Yeah, so just building on our previous question, so looking for solutions here. Asier?
I was just going to say, is it for Pablo or for me? So when I look for solutions, one of my biggest frustration from working in Brazil was that microfinance is put within the impact investment bucket, as Pablo said. When I think I agree, and I think I understood what he said. When I agree, it's completely wrong. Or I'm not sure if the word is wrong, but we are like the expected results are mismatched. So a lot of people put microfinance as part of impact investment because it's assumed that the businesses that receive these loans will have an incredible impact on the ground. But based on the guidelines of how microfinance works, it's absolutely impossible. And a lot of it has to do with the time frame. And it's virtually impossible for businesses to go beyond surviving, much less to create a new one, if you have to begin returning, that sort of that investment that you got through a loan, even within 1 or 2 months, right? Which are sort of some of the limits we got. And those limits didn't come from, greedy funds. They came from, development and social economy development banks in Brazil, for example. So there's a lot of and the reason why I'm saying this when it comes to, for this question is, how do we break away from that, the mismatch between the conception of what impact investment is and what are the different categories associated with it, the expectations, all of that is completely messed up. And that's why also you don't have enough, funding for pre-seed capital, like Paulo was, stressing. And I've heard him say this before in other conversations. This is, really tragic. So when I think of Brazil, for example, for Latin America, how do we work around these areas, not just in microfinance, but and impact investment and other opportunities? Is how do we create, what are the sort of organizations that we can develop to create or to foster the connection between potential investors in Brazil? For the case of Brazil, there are many, like Paulo said, depending on the country, it varies greatly. But how do we get organizations or leaders or group of people to build communities of investors and social entrepreneurs? For example, how do you work with an organization like Ashoka that Pablo is also a part of to deal with this mismatch of expectations about what the funds are going to do, the impact they're going to have, and how do investors learn from entrepreneurs and vice versa, because there aren't any clear opportunity where they can both work together. And a lot of times we say it's because we're far away or they're in different countries or language, and we come up with certain excuses, but if we deal with it at the local level, it's much easier to make it work. A lot of these countries are capital rich. Not all developing countries are in the same bucket. And I would say that we need to give a lot more space to experimentation. If we want, innovation, we need to digest a certain level or accept a certain level of risk and experimentation. And that goes to the role of government in this, the role of private investors and other companies. In my experience in microfinance, there's no understanding of how local businesses can grow and create more impact. Sometimes they think impact is just creating jobs, but how do you actually transform the way local economies work? There's no way it can function without a different understanding of how risk works. So I would try to create communities that help educate the different sides on those areas, building incentives from the government perspective, and having more money to experiment and allow this innovation to be also not just a transformative experience, but a learning experience for entrepreneurs, beneficiaries, and investors.
Thank you. Thank you very much for that, Asier. Pablo, so what would you recommend in that sense? Which internal changes would you recommend?
So I do think this is not only in developing countries, but in general. But the first thing I will say, we need better role models. So this means stronger role models in investment. But in order to have good VC funds or even business angels, we do need to support more entrepreneurs. The reason why certain ecosystems globally are so strong is because they had a lot of entrepreneurs with lots of exits. So therefore the ecosystems get stronger. So we need more success stories of Nigerian entrepreneurs that create that impact investment fund. So that then we can, generate that development from within. So that's one thing. The more role models. You need to work on the supply side and the demand side. Then from the capacity building of investors and, let's say, entrepreneurs. So from the investors, one of the things that you read any report about impact investors in developing countries, and one of the main challenges, it's the processes are not set up. They invest based on factors that are not really related to even risk or impact. So, they're very, they're not up to the standards that others, or that generate the trust for other funds or funds of funds. So that there is a lot of capacity building necessary for investors from the investor side. And then from the entrepreneur side, if you look at incubators and accelerators globally, but especially in developing countries, most of them are not sustainable as organizations. They still depend on grants or, basically agreements with corporations or with governments to survive. And and if you look at the statistics, only 18% of an incubator or accelerator budget goes into supporting startups. The rest is for their own self-sustaining costs. So if you are, as an organization, you spend, let's say, 82% of your budget in your own organization, you have a problem, no? And this is one of the main challenges that incubators and accelerators have globally, and it's very, very dangerous in developing countries, where many times for entrepreneurs, this is the only way that they can get their foot in front of an investor. And when you talk to investors, especially early stage investors, they tell you that entrepreneurs are still not ready, because incubators, accelerators are not preparing them to speak to investors, to have a viable business plan. So you need to work on both sides, capacity building on the investor side, capacity building on the entrepreneur side, so that you can really generate a more more professional conversation from both sides, because otherwise you're just going to end up working more on the informal, and it's those decisions are going to be made more on close contact, and so then you generate these endogamic challenges that do not generate anything good for the world. And then the other change that I will or recommendation will be working with family offices. With basically, I think there is a lot of potential, especially in developing countries, working with family offices so that they start changing their portfolios in more impact investment. And some of them, they are already switching to or devoting a part of their assets in in early stage or even later stage. But this is something that it's growing, so it means we need to capacitate, we need to train family offices to know how to invest locally within where most of the fortune was made, or even where the founders were from, and not just move it to other places like what happens typically. So I think lots of actors need to start upgrading their capacity. And I think others that have been moving their money elsewhere should start investing, where they're from. And that brings the topic to of diaspora. And I know Grace and Asir, we've talked a lot about it.
Oh, thank you very much. So in the interest of time, I'm actually going to move to the Q&A session. Amelia, I believe have you collected any questions, or is there anyone in the audience who'd like to ask a question?
That is a great invitation, Grace. I want to start with Mark Canucciari. Mark, I will invite you to talk. Of course, you don't have to if you don't want to, but I've sent you the invitation.
Hi, yes, can you hear me?
Yes.
Hi, thank you for the presentation, everybody. It was definitely enlightening. I'm currently studying an ESG investing certification to the CFA. And I was curious to know, I know we talked a little bit at the beginning about how there was a lack of coordinated standard. I know ESG might be a little more larger scale, but I was wondering, even at the entrepreneurial level, but kind of what Pablo was talking about, is there a standard by which maybe in African countries that they're following, or also South American countries that they're following, or is this still a developmental process where larger institutions, say asset managers, they're looking to follow? Like, I know the CFA has their own and they're pushing ahead with it, but I was wondering if is there another one that is more of a keynote that we should be looking at as well?
So in terms of because ESG standards, entrepreneurs, we don't really use those. But even just looking at the criteria, it's still very broad. What I will say, it's in the earlier stages, what the method that is more standard among impact investors is, are you able to develop your theory of change, and do you have the right indicators? And those indicators, you can use IRIS from the Global Impact Investment Network. You can use, there are a few other, let's say, indicators, standards that you use, but for early stage entrepreneurs, you don't really have the capacity to do any really heavy impact measurement process. So at the end, it's really up to the impact investment fund to decide what are the 3, 4, maximum 5 indicators that you're going to measure on top of your financial indicators to measure success. And this is a problem that I think the entire industry has, that there is not a real standard. But then how do you compare, supporting, 5,000 seniors to actually have a good end of, life? Or how do you compare that with, putting 200 kids to school? There are measurements or methods where you compare that to the dollar value, but then you get into all those moral issues about what's worth. So I think at least the part that I can speak about, it's the earlier stage of impact investment, and there is no standard. There are standard frameworks that are finally a reality. I think the European venture philanthropy really pushed for that. But then in later stages, it's really not my expertise, so probably I won't speak about that.
Okay, but there's another question for you here, Pablo, from Rothio, who is asking, what is stopping investors from getting more involved in early stage funding? What is this barrier, and what are the missing infrastructures?
So one is the entrepreneurs are not ready. If in San Francisco you can get 1 million with a PowerPoint, in other countries you can only get it with 100K or 200K in revenue. So you see from the entrepreneur side, some of them are not ready, but also what investors are expecting is very different because their risk appetite is very different. So what are some of the barriers? Well, culturally, investors are much more risk averse in some areas than in others. So we need to work on what venture capital means. If it's just private equity for small firms, that's something else. But venture capital there needs to be venture, there needs to be risk. So working with investors on how to manage risk is one of the main barriers. And then the other side, from the demand from the entrepreneur side, is getting them ready with more support. Most entrepreneurship ecosystems globally, but especially in developing countries, do not have strong incubators and accelerators, and the programs that exist, they support very few, 10, 20 entrepreneurs a year. And this more or less matches the number of investments that happen. So you can see that if there is support at the earlier stages, there is going to be eventually some funding. If there is not a lot of support, a lot of capacity building, a lot of network building, social capital build, then it's going to be harder for early stage entrepreneurs to connect with early stage investors. So a lot of what's called now the social collisions need to occur. So for business angels to connect with entrepreneurs, but it's more of there is a lack of infrastructure, and there is a lack of there's a mismatch in expectations.
If I can add something to what Pablo said, besides like the infrastructure and getting entrepreneurs ready, I think, and this is true everywhere, but even more in developing countries, is that the investor community tends to look at the usual suspects or the usual places from where to look to this potential entrepreneurs and investors, and there's very little effort to reach out to different places. So we know, for example, in the case of Brazil, there's a lot of innovation happening in the urban periphery that is completely ignored by the universities, the think tanks, the funds, the financial community or system at large. And I think there needs to be an intentional effort to look in those places to ensure that we have this diversity that we talked about this, and that we actually create opportunity and not just bring more inequality through impact investment.
Right, and there's another question. There's a question from Rebecca, who is asking, how do you think big data can help in impact investment?
Well, I do think that basically all maybe I wouldn't call it the big data part, but all the impact measurement that we can do, I think big data can help, but I think it still is very dangerous. I don't think we have enough data to predict that if you invest 1 million in building X or Y, you're going to generate that. I don't think we have enough data to use it, but I do think that yeah, I think just digitalization of impact measurement, it's already at where the bar is. I wouldn't even go for big data. I think if we can digitalize impact measurement and evaluation for most of the organizations, nonprofits, social enterprises, like that's already a huge win. And then with a lot of data, then we could potentially come into the study of that.
I would say there is one area where I think this could be helpful. I agree with everything that Pablo said. Digitalization is one of our biggest, for example, challenges, even for social entrepreneurs, talking even beyond impact investment. But I think there's one area, and I speak this from personal experience. So in Brazil, I worked in this network of community banks. There were 100, and we went from, digitalization was the first process, and the currencies went from being on paper to digital. And we ended up developing a platform that became sort of like a social fintech in Brazil. It's still a nonprofit organization that receives some funds even from for-profit organizations like loans, etc. But getting to your question, in this avenue, I think there is potential because this organization in Brazil, it's generating a lot of data about local consumption, local production, about investment, how people are spending their money, in what ways, how they pay their bills, the time frame in which they do it. Like there's even space for some behavioral economics like studies. I know there are a couple of friends who want to do this with us in Brazil. I think there's opportunity there. But I would go back to one of the first things that Pablo said in that answer. Like we have no theory of change of what sort of impact we're going to be able to do or achieve through using big data tools to analyze all the data that the organization is currently gathering. But I think it's a very interesting avenue to work in on this kind of aspect on financial inclusion.
Oh, thank you. Amelia, do you have any other questions for them? Amelia?
I don't have any other questions, but Rebecca just asked for Azir, what is the name of the FinTech organization? And then Rocio would also like to follow up. So Azir, I'm sorry if I'm saying your name wrong. What was the name of the FinTech organization you were speaking of?
Okay, so the organization, so it all begins with an organization called Banco Palmas, which is the first community bank in Brazil. This was created by an Ashoka fellow, just like Pablo, who created this organization. And the name of the fintech that we developed started 5 years ago, and it's called Instituto e Dinheiro, and I can write it. There's an article I wrote with 2 researchers on how we went about this that should be published early next year that talks about this. So I can share more later on, but I'll write it on the chat.
Thank you, Azir. And Rocio, I'm going to invite you to use your mic and you can follow up directly with your question.
Thank you. And thank you to all of the speakers, like incredibly interesting insight. So I wanted to follow up on what both of you, Asier and Pablo, answered me, and ask like how can these entrepreneurs be found by incubators, accelerators, by investors in general? Like should investors and organizations in general looking to help these entrepreneurs be looking for people that already have a product or idea? And how do you find these entrepreneurs that are being isolated or not looked at? Because I think the point that Asier made about not creating further inequalities with impact investment is extremely interesting. And I just don't fully understand where are the areas that these entrepreneurs are not ready. Is it that they're creating bad business plans? Is it that their initial idea was just not well thought out and is not actually assessing a need in the market? So that is a lot of questions in one, and I know we don't have much time, but whatever you think that you can answer would be great. Thank you. So
I'll answer this one. So just to give numbers, I don't know if you guys know VC4A. It's a platform where you can entrepreneurs can connect with investors from all over Africa. And this is in 2019, out of 13,500 startups, only 427 got some funding. So around 3% of the startups in this platform got funding. So there are plenty of entrepreneurs. I mean, when you look at an ecosystem, there are 5 actors: entrepreneurs, investors, corporates, governments, and universities. And I think this is globally, but most of the ecosystems, the entrepreneurs, if there is an exam, it's A+. I think we are doing it well. I don't think it's the same for the investment side. One is risk appetite. So Rocio, one of the main challenges that entrepreneurs in less developed ecosystems face is they need to be selling and they need to be proving that there is growth before they get investment. But then it's the chicken and the egg. How can I get to that if I don't have funding? So you could say, you know, a lot of investors in developing countries do not trust that the entrepreneurs are going to go through that process through that valley of death successfully. So therefore they're not going to invest. There are definitely enough startups. The challenge is not where they are. It's really, are they meeting and are they speaking the same language?
So to try to answer that question, going to what adding to what Pablo said, I do think that there's a problem, and of course there are plenty of startups and not enough funding, for sure. That's one thing that needs to change. But also, if you look at where those startups come from and who is behind many of those startups, not just on the investment front, but behind the entrepreneurs, you also see inequality within the country. So if I look at a country like Brazil or Colombia, you see a little bit of it. So right, certain groups and people benefit from that inequality, and that's what I was referring to. And so I think you know, you need to build on the infrastructure that Pablo was referring to, and just be intentional about where the entrepreneurs and the ideas or the startups are coming from, making sure that enough of them could come eventually from somewhere. So it's not enough just to say 20% of the startups need to come from the urban periphery in these cities or in these countries, but you actually need to create the opportunities to ensure that happens at some point. It might not happen in 1 month or 6 months or a year. That's why what Pablo said at the beginning, like everybody needs to do a little bit of upgrading the way they're working in many ways, and more of the fault is with the investors and the intermediaries and with the entrepreneurs, for sure.
Thank you so much.
Oh, sorry. Aldir and Pablo, we have one more question, Grace, as well. I don't know if you have 15 minutes or 10 more minutes to answer this last question.
Yes.
Excellent. Okay, so then Carolina, I am going to invite you to ask your question directly and maybe clarify a little bit what your question is. I couldn't follow it in your text.
Hello, can you hear me?
Yes.
Perfect. I would like to ask how would you define the role of social entrepreneurship and impact investment in advancing the SDGs and the global challenges?
Well, I do think that if, let's say that social entrepreneurs and impact investment, our goal is to advance, social impact. And definitely, if you look at the SDGs and the SDGs and the targets of the SDGs as a goal for 2030, as a global society, I think it's 100% aligned. It is true that lately I've seen many more funds and even programs using SDGs as a standard. To me, it's relatively it's very concrete. It's very concrete, but at the same time, it's a bit simple. The way that the SDGs are set up. But I think if it's the standard that everyone starts using it, then it's great. So the answer is yes, it's 100% aligned. I think that there are frameworks that are more detailed than the SDGs because it paints the direction, but it doesn't really paint the picture of the distance that you're walking on. Yeah, definitely it's the way to go.
I would say, first of all, like social entrepreneurs have been working on similar issues from much before SDGs were created, right? So of course, SDGs have in some ways helped the business world and government align in some direction. But social entrepreneurs have been dealing with these issues from the beginning. And I would argue that they have a more systemic approach in dealing with these issues. So when you look at the SDGs, which is, looks terrific and interesting, it looks like the grocery list, right? The kinds of things we need to do when you go shopping. And it doesn't read, it doesn't help, I think, in my opinion, it doesn't help people or the public at large or society to demand more systemic approaches to how we're going to change this. So if you look at climate emergency, it deals with a lot of this list, right, of SDGs that we have to achieve. And I don't see any conversation around that. And I think that's something that from the perspective of Ashoka now, I think, and Pablo is one of this, these fellows. I think when we talk to fellows, they have this approach of trying to see how these pieces fit together and we can achieve a larger change, Anyway, so I'll leave it there.
Okay. Yes, we are 1 minute over time. I just want to thank all the attendees, especially our panelists, Pablo and Asier. Thank you so very much for your valuable insights. You've given us a lot to think about, and hopefully we can, people can be able to structure impact investment in a better way and not wait for another 50 years like we waited with aid to see that it actually doesn't work in the current format, though the intentions are all good. So thank you. Thanks also to the Net Club and the Asset Management Club for hosting us. Good evening, everyone. And my students, thanks for joining. Rothio and I think some other students are also online. So I'll see you in class tomorrow. Bye.
Thank you, everyone.
Thank you, everyone. And for the attendees who are still on the line, our next panel is about reimagining energy at 4:30 p.m.